Profit surges in renewables often seem like pure sunlight, until you inspect the layers beneath. Raslag Corporation, a leading Philippine solar developer, posted consolidated net profit of 509.4 million pesos in 2025, up sharply from 66 million pesos the year before. Revenue climbed to 723.7 million pesos. For growth-focused investors, these numbers signal a platform scaling up. But the reality is more complex and more instructive for those seeking lasting value. Part of Raslag's gain was truly operational. Its fourth plant, Raslag 4, entered full commercial service, adding a robust 36.6 megawatts of capacity. Contracted sales rose, anchored by a 10-year, 15 megawatts deal with Pelco I, pushing contracted capacity near 80%. This meant stronger, more predictable cash flows, less exposure to market volatility, and the fleet expanded to nearly 78 megawatts. The business, in short, is better built for recurring revenue. But 2025's headline profit did not rise solely on current operations. Regulatory and accounting factors played a decisive role. The key non-operating boost was the FIT adjustment. Late in the year, government regulators approved multi-year tariff uplifts, covering 2021 through 2025. Raslag was allowed to book 169.1 million pesos in accrued revenue all at once. It ended the year with a larger transco-related receivable, a clear sign of this catch-up. This adjustment inflated both revenue and earnings materially, yet only for this year. The same uplift cannot recur. Another major earnings contributor came from asset monetization, a substantial land sale, booking roughly 286 million pesos after tax. That's income not earned by generating power, but by selling property. Raslag also monetized renewable energy certificates, diversifying its other income stream. Why is this distinction critical for investors? Because markets tend to capitalize whatever profit they see. Yet not all earnings are equally repeatable. A peso from contracted solar output is fundamentally different from a peso booked on regulatory true-ups or asset sales. Raslag's results were strong, but not entirely clean in the sense used by analysts. EBITDA grew 102%. Net cash from operations increased 46%. These signal real operating progress. Yet, the outsized net profit reflected a blend of recurring and one-off gains. On dividends, the question is obvious. With profit up, should payouts follow? Raslag declared 75 million pesos for common shares, split between regular and special dividends, plus 13.1 million pesos for preferreds. But its policy is anchored to 30 to 50% of core net income, not the headline number. Special dividends can reward exceptional years, but sustainable growth demands recurring cash flow, not windfall gains. The company's financial position is solid. Cash, assets, and equity all grew. Still, future dividend growth depends on steady expansion in contracted output and prudent execution. The FIT adjustment's one-off nature is often misunderstood. While FIT-backed revenues from eligible plants are recurring, the 2025 multi-year catch-up is unique. Raslag booked several years' worth of uplift at once. From 2026 onward, ordinary FIT revenues resume, and that back pay cannot be repeated. Cash collection from this uplift will happen across several years, but the accounting gain has already been recognized. The conclusion is clear. Raslag had a genuinely strong, but complex, 2025. Its platform is larger, more contracted, and better capitalized. Operational progress is real. Yet headline profit was flattered by regulatory and non-core gains. Investors should welcome the brighter outlook, but temper expectations. A single year's windfall is not a new normal. Dividend growth will be measured, tied to recurring cash flows and long-term project success. In solar as in finance, a standout year shines, but enduring value takes patience, realism, and steady execution.